This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, everybody? Happy Tuesday. Welcome back to another Benzinga Live. It's, I think, officially, I don't know, but I think it's allergy, cold or flu season, so I've been dealing with a little bit of stuff, so I apologize if I don't sound as good as I normally do, but thanks to everyone that is going to be hanging out with us. Regardless, we've got a packed show today that I'm very excited about. Of course, today the big news in the market is about regional banks. The KRE Spider S&P Regional Banking ETF is up more than 5%. As we're seeing a little relief rally in all these banks, as Janet Yellen spoke yesterday about how the government will intervene and hopefully make sure all depositors are made full. If there should be more problems, more bank runs at some of these banks, we're going to have Tim Melvin on at noon, our regional banking expert, to discuss what's going on, discuss the latest, any updates there. But before we get to that, I've got a first-time guest hanging out backstage that I'm real excited to bring on. Scott Powell with Skyline Communications. No, not Skyline Chili, but I don't know if Scott's familiar with that, but I'll make sure to ask him. But without further ado, let's go ahead and give Scott our very special Zinger Nation welcome, and we'll be talking about Skyline when we come back. Mr. Powell, how you doing today?
Excellent. How are you, Aaron? Thanks for having me on.
Of course. Welcome to Benzinga Live. Hope you're having a great Tuesday so far. Where are you joining us from?
Joining you from our New England office.
Okay, awesome. So before we get started, why don't you just give us a brief rundown of what Skyline Corporate Communications Group is, what are the types of companies you're working with, and any relevant information that we need.
Sure. Thanks, Aaron. And it's a pleasure to be on Benzinga Live. Appreciate the opportunity here to join and tell everyone about Skyline Corporate Communications Group, LLC. Skyline is an investor relations and corporate communications agency. We principally help small and micro-cap public companies with their communications platforms, both to assist them with telling their story in a more impactful, concise, and compelling manner, and also working with these companies to broaden their exposure within the financial community, whether it's with investors, analysts, bankers, and the media. We have offices in New York City, Boston, and suburban Massachusetts. And as I said, we work primarily with small and micro-cap publicly traded companies, as well as private companies that are planning to enter the marketplace, typically through an initial public offering.
Yeah, and we've seen, correct me if I'm wrong, but there's been, a lot fewer companies trying to go the IPO route throughout the past year or so as interest rates have come up. Have you guys been noticing that as well?
It has been a challenge for some of our clients. Most of our clients are NASDAQ listed, but we do have a handful of OTC traded companies as well as a handful of private companies. And in most cases, the companies that we're planning to uplist to NASDAQ or NYSE, they've had delays or challenges in terms of getting that uplist completed. And certainly some of our clients that had planned on IPOs, those have been delayed a little bit. We were lucky, though, or our clients were lucky. A number of them did get IPOs off last year. But definitely it's been a challenging 2022 and a challenging first quarter of 23, for companies seeking to enter the public marketplace.
Got it. And so what are some of the, like OTC or small cap companies that you have worked with? Any, ones that have been doing particularly well throughout this challenging environment?
They have weathered the storm, I think is a good way to put it. We advise our clients that in difficult markets like this, when it's difficult to access the capital markets, it's more difficult to raise money. It's more expensive to raise money. The cost of capital has risen when markets contract. So we've told our clients, to focus a bit less on where your share price is trading and whether you think it's undervalued or not. Focus more on making sure that A, you have enough cash to get through any difficult periods, and B, you're focused on growing the business. You're focused on operations. So growing top line, growing bottom line, growing margins, maybe closing some acquisitions that you have lined up, focus on that integration, maybe launching new products or services. So really focusing in these difficult times on making sure you have enough operating cash so you can protect your employees and your shareholders, and then focusing on growing the business. And eventually when the macro headwinds abate a little bit, and they do, and they certainly will here, that the share price will come more in line with what the management team thinks is a fair share price and a fair valuation for the company. But in the meantime, focus on growing that business and focus on operations.
Yeah, and I mean we know that kind of all too well here at Benzinga, of course. Dealing with covering markets of all sorts, public markets, alternative investments, whatever. There's been just a downturn, to put it, simply, over the past year or so. So, we know how that has gone. What are you looking forward to, I guess, as we, trek into 2023 and beyond?
I mean, we're looking forward to a more normalized market. There obviously have been a lot of negative macro trends that have impacted the U.S. capital markets, and then I think a lot of us got caught by surprise with some of the banking issues that have arisen, with SVB and Credit Suisse. I mean, those were pretty big surprises, I think, to most folks. So it looks like actions have been taken to to protect investors and protect some of the banks that have had some of these issues over the past few weeks. So hopefully some of the macro headwinds will start to abate. Hopefully you'll start to see more IPOs, getting back to maybe not 2021 levels, but sort of pre-COVID normal levels of initial public offerings, of secondary offerings, of uplists. So, we've been talking to a number of traders on the floor of the New York Stock Exchange over the past few months, and we're hearing from them that there's some optimism that come summer or come fall, some of the macro headwinds will abate a bit, and we'll start to see more and more IPOs, more secondaries, more uplists, and I think that's good for everybody, for issuers, for investors, and for the public alike.
Yeah, and so you brought up 2021, so I got to ask. I mean, coming from the IR world, do you think have you seen a lot of companies that want to, I guess, market themselves more to retail investors after seeing the success, or not this, I guess I should say success, but I guess the, after GameStop, AMC, et cetera, I think a lot of people realized, okay, wow, retail investors have a lot of power. Have you noticed a lot of companies maybe wanting to get more involved with retail investors than before?
Yeah, definitely. I've been on Wall Street for a long time, and certainly the last several years has been a dramatic rise. I think not only in the amount of retail investors participating in the public equities markets, but also the power and influence that retail investors have had. They've really, over the past few years, have really shown a powerful voice in terms of bringing attention to certain stocks, to certain companies. So I think it's a voice that cannot be ignored, and there are a number of ways to try and harness that. At Skyline, we help our clients to set up their social media sites, to post content on social media, because that's where a lot of retail investors get their stock ideas, their trading ideas. We encourage our clients to reach out to different media platforms and media outlets for interviews and articles, again, because that targets a largely retail investor base. And we work to get our clients in front of stockbrokers and retail investors through both in-person meetings, in various financial centers like New York City, but also doing virtual events where we can get a number of retail investors to zoom in for a presentation by some of our clients. But clearly there's an interest in harnessing the retail investor, and we're doing our best to help our clients facilitate that access.
Yeah, and that's what kind of where we're, at Benzinga, we focus on the retail investors, and we've, like you said, there was a big influx in new traders, new investors in 2020, 2021, and part of that also you saw a lot of companies realizing, hey, we don't need to just, try to court institutional investors or whatever. We need to also focus on retail investors. So, you mentioned, looking forward to some of these macro headwinds stabilizing in 2023. Specifically at Skyline, what are some of the initiatives that you guys are doing right now to try to help these companies, like you said, weather the storm until we get to that point, until interest rates start coming down, or until, this banking situation is more clear and figured out?
It's a great question, and it's timely because I had a call this morning from one of our clients, a NASDAQ listed technology company, from the CFO, and he was asking me the exact same question. He said, "Scott, we're really frustrated. Our stock is at a not just a 52-week low, but a multi-year low. It's not justified. The company's never been healthier in terms of our cash position, in terms of our operations." And he said, "It's really frustrating. And what should we do? Should we just give up on investor relations?" And I said, "Absolutely not." I said, we don't have to be as aggressive, because sometimes when you're facing a lot of macro challenges, sometimes a lot of investor relations efforts are not that impactful because they can be overshadowed by some of the macro factors. But I said, you can't just go quiet either. So I said, why don't we do some lighter touch investor relations work that doesn't require travel, doesn't require a lot of costs for you as an executive team. So let's look at some social media options. Let's post interesting content on your social media sites that are related to your industry, that can draw attention into your technology, to your products. Why don't we do that? Why don't we look at some media interviews where, of course, with the pandemic, a lot of things can be done virtually now. You don't need to travel to New York or Chicago or what have you to do in-person interviews. You can do these virtually, and they're not super time consuming. They're not very expensive. So we're looking at some of these modalities and options, that are impactful and able to reach a broad audience, whether it's institutional or retail, that are convenient and cost effective for our clients. So it's a very timely and good question.
Yeah, that's awesome. I'm glad you recognize, that. And I guess we love doing the virtual interviews, as you can see. So if you guys ever have any, companies that you think would be interesting to retail investors, et cetera, would love to, set some of those up. Scott, is there anything we didn't get to today that you would like to talk about? I know we're gonna, bring you back on in a week or so, so we could discuss some topics and whatnot for that one as well.
I think just talking about investor relations, there's a theme that's been occurring with our clients. There's a lot of frustration with our clients saying, look, Scott, our company's never been better in terms of operations, profitability. We signed up new licensing deals, or we launched new products, or whatever it might be. And there's just this frustration that, are our investor relations efforts really worthwhile? And we tell companies, look, investor relations isn't something that you just turn on and turn off. You turn on in good times and you turn off in bad times. It's something that can be dialed up and down in equal measures, but it's not something you turn on and turn off. You need to be consistent. You need to be in front of investors, at conferences. But we can look at ways to be cost effective. We can look at ways to, conserve time and energy by doing things virtually, by doing things on social media. So again, I think it's important, as I'm sure a number of companies that, Benzinga follows are, and I'm sure there's a lot of frustration coming from these executives. It's just something you have to stay the course and weather. And you can, don't turn investor relations off, but you can dial it back a little bit, be more cost effective. And then when the macro headwinds tend to subside or abate, you can get a bit more active with your investor relations efforts.
Yeah, I think, and that's what you saw in a lot of in 2021. The markets were at the highs. You had, basically a lot of companies trying to court retail investors, et cetera. And like you said, though, it's not time to just turn that off when times get bad. It's you have to still be strategic with that communication and figure out exactly what these more challenging times mean for specific companies, and a lot of times those are the best times to buy as investors. I mean, we saw how many people got into the markets and got burned by buying certain stocks at highs in 2021 because I think, and that's just more like the psychology of the market, right? When stocks are going up, people want to, they have fear of missing out and want to buy in. But when stocks go down, I mean, this is the time where you can really look at some of these companies, especially in the small cap space where some of these stocks have gotten absolutely decimated, and they can be really good opportunities for the long run. And I always tell people, especially like newer investors, newer traders, like pick areas that you're already interested in. Like if you're a big tech guy, look at some small cap tech stocks, or if you're into medicine, look at some, biotech stocks. Are there any particular sectors or industries that you work, more with than others?
We're an agnostic firm in terms of sectors, so we have clients, across industries. I suppose, like most investor relations agencies, we tend to have a lot of healthcare and technology companies, but we work with companies, in real estate, metals and mining, consumer products, you name it. We're pretty much across the board in terms of industry. But I agree with your sentiment and your analysis, Aaron. There are a lot of, I think, good bargains out there, particularly in healthcare and tech, where a lot of these companies have just been really battered. A lot of them trading at, at or below cash. I think, investors should look for companies that, as I mentioned earlier, have enough cash to weather the storm and are trading at deep discounts, but with defensible positions and cutting edge products that, will survive. And that's important to make sure the company can weather the storm. If they're not able to raise capital, on decent terms over the next few quarters, then maybe a stock that you want to maybe shy away from. But if the company is well positioned in terms of a nice cash position and has growth prospects through disruptive or innovative products, it's really a good time potentially to look at some of these stocks.
Got it. Well, Scott, thanks for hopping on Benzinga Live with us today. It's been a great conversation, and always love talking about IR. I mean, I come from a more like strategic marketing, strategic communication background, so I understand kind of, the challenges and what's going on there right now. But again, Scott, hope you have a great rest of your Tuesday, and look forward to having you on again in the future.
Thank you, Aaron. Appreciate having me on Benzinga Live, and look forward to speaking with you again.
Of course. All right, guys, that was Scott Powell from Skyline Corporate Communications. Again, we're going to be talking to Scott again soon. We'll bring on some of those companies as well. I see our next guest just hopped in backstage. Look at that timing. Tim Melvin, our regional banking expert. Before we bring Tim on, let's just do a quick rundown of the overall market. I'm going to go ahead and pull up my Benzinga Pro, your one-stop shop for everything you need when it comes to trading and investing. I mean, you guys see me use it every day here on the show, whether you're looking for charts, fundamental data, etc. It's all right here, available in one stop on Benzinga Pro, pro.benzinga.com for a free 2-week trial, no credit card needed, so you have no reason not to check it out. Let's start with the big news of the day. KRE, the Spider Regional Banking ETF, up more than 5%, absolutely ripping, and it's bringing, I mean, it's helping everything out. Look at SPY's up 0.5%. You look at the Q's up 0.3%. Your Dow Industrial Average up about 0.5% as well. So seeing the S&P 500 and the Dow actually outperform the Q's on the day shows me that the strength isn't obviously in tech. You got to look at like the XLF financial sector, XLE energy strong today too. And I mean, I know it's not this simple, and nothing in the market is that simple. The crow, you want me to wear the crown behind me? I mean, I haven't done anything to be really king-worthy today, but I did buy a lot of these regional banking stocks, so it is a good day for me, and maybe if they keep going up, I will be able to afford a castle one day. But anyway, seeing on a day, and I know it's not this simple, it's never this simple in the market, but when you see energy and the financials trading higher by a significant amount, I mean, look at this, XLE, XLF, both up about the same, 2.4%. That is not really typically what you see in, a recessionary environment or anything. So I think a lot of people a lot of people, for whatever reason, that are very doom and gloom or perma bears, kind of the zero hedges of the world, if you will, took this whole banking situation as an opportunity to say, see, the sky is falling, everything is bad, this is '08 all over again, everything's gonna crash, sell your stocks. And I don't, I was always kind of looking at that stuff on Twitter and Reddit or whatever, just being like, really? I mean, it doesn't really seem like the same situation as '08 when you look into it. I mean, sure, the fallout from SVB collapsing has been, I think, bigger than what some people expected, myself included, but it still doesn't mean that there's going to be this, huge collapse. And I'm sure Tim will talk about this as well. Let's check out some of the other, just biggest names in here. Apple, relatively flat on the day. Apple up about 0.05% right now. So yeah, I just went red on the day. Wow. Microsoft, news that Kathy Wood adding some Microsoft into her portfolio. What about how are the bigger banks doing? JP Morgan up about 3%. Schwab up about 5%. Wow, Schwab, strong day on Schwab. All right, guys, it is noon, though, so without further ado, let's go ahead and bring our next guest on. We're going to go ahead and give Mr. Tim Melvin our very special Zinger Nation welcome. When we come back, we'll be talking regional banks, the banking sector as a whole, and any updates that Mr. Melvin is seeing on the situation. Mr. Tim Melvin, welcome back on Benzinga Live. Thanks for hopping on kind of short notice here today.
Oh, no problem, guys. I'm always happy to come on around the noon hour here and talk about banks. I never don't have time to talk about banks.
Yeah, I mean, it's probably been a fun past couple months for you, or a couple weeks for you. I'm sure a lot of media hits and whatnot. So I want to start by, we had you on a couple Fridays ago, right after the Silicon Valley Bank collapse. Have you been surprised seeing the price action in some of these stocks? I mean, I know at that time we talked about First Republic and Western Alliance specifically as banks that are actually strong and not in the same situation as Silicon Valley Bank. I remember you saying, don't assume these institutional investors and money managers are really, quote unquote, like smart, like they might be selling just because they don't want to be on the hook when the quarter ends and saying, hey, why'd you hang on to these stocks? Is that kind of what you think happened? Or again, are you surprised at seeing the price action?
No, we were buying last week heavy. And, we've gotten a lot of the comments. Western Alliance, I mean, I don't know if you remember, I said, look, this is overdone. And it shot higher right after we talked. And then the next morning it opened back down at like $7. So I went from smart to stupid, and now I'm smart again. But, New York Community Bank, same thing. We've got that in an income portfolio in our one of our MarketFi products. Everybody's like, oh, my God, the stock is down. It's the end of the world. I'm like, no, it's a buying opportunity. Because, Aaron, here's the truth of it. There was no banking crisis. There just wasn't. You had two crypto banks that got seized. One voluntarily liquidated. One got seized by the New York regulators. That's going to end up in court because there's a lot of questions about whether or not that should have been done. And then you had Silicon Valley Bank Corp that made a really bad bet on interest rates. And then you had the related venture capital withdrawals. But, last week when everybody was panicked and, the Fed's increasing their balance sheet by $300 billion and everybody's rushing to the Fed window to take all this money out, this new emergency program, we looked at the Fed release numbers on Friday. All of the money at the emergency window, as in every freaking dime, came from New York and San Francisco. 20% from New York related to Signature Bank, 80% from San Francisco related to Silicon Valley Bank shares and First Republic, and Silvergate. Then we turn around and we look at the regular window pledgings, the $300 billion's there to be sure. $142 billion of what was withdrawn or pledged at the window was related to the 3 banks that were seized. There was no banking crisis. We saw instant bank experts pop up all over the internet. I've never seen so many new experts since March of 2020, when everybody had a degree in epidemiology and virology within about a 7-day period. We had all the same experts on there talking about uninsured deposits and security holdings. And guys, there's been uninsured deposits in the banking system since we invented deposit insurance in 1933. In the continental Illinois and Penn Central banking crisis, the uninsured depositors did not get paid off. Those were 2 banks. In the great financial crisis, which was an actual banking crisis, okay, we had loans defaulting. We had stupid loans in the system. We had excessive leverage. We had collateral values collapsing. Take a wild guess how many uninsured depositors lost money.
I don't know. I have no clue.
None.
Like company?
None.
Wow.
Not a one.
In 08?
In 08, 09, no depositors lost money. They were made whole. 325 banks, not 3, failed in that time period. Now, yeah, banks have losses in their securities account. Absolutely, they do. If you bought securities, rates have run up, unprecedented rates, you've got a loss. You've got to mark that mark in your available to sale holdings every quarter. You got to mark it for earnings. You got to mark it against your book value. You do not mark it against regulatory capital unless you sell it. As long as there's no deposit run, you're not going to sell it. So banks have not really seen a deposit run in the community and regional banks. We've seen some transfer of funds, and this is hysterical to me. Everybody came out, and all the new experts told everybody, get your money out of these smaller and regional banks and transfer them to the big banks. They're too big to fail. Do you know which banks have the most uninsured deposits?
The big ones.
The big ones. The small, and it's like linear, right? The bigger you are, the fewer insured deposits you have. Till you get down to your smaller local banks, they have 80 and 90% insured deposits. Now, a couple of things here. First off, don't run down and take your deposits out and transfer it to JP Morgan or Citi. They don't need it. Your local bank, it does. If you have more than $250,000 in the banking system and you are not using a service like IntraFi to manage your deposits between banks, then you're making a mistake, because they'll go up to the billions of dollars level of making sure you've only got $250,000 in each bank. They've been a valuable source of deposits for community banks for years, but they can really protect both individual and corporate people looking for insured deposit bases. So there's not really a banking crisis unless we have a bank run. And if everybody will shut up and they'll lock Janet Yellen in a closet, we won't have a bank run. No.
Well, and also, I mean, like, if there were to be a bank run really in these regional banks, like, don't you think that would have happened like directly after? Like, the more days that pass, like it would have happened like the Monday, Tuesday after Silicon Valley Bank collapsed, the more days that pass. And we have such short attention spans now. There's so much in the news cycle that like people aren't going to be even talking about this in 2 weeks, let alone running to their banks and pulling money out. And the other thing, I mean, with the, I see Jay Rice in the chat saying JP Morgan has $1 trillion of uninsured deposits. I get it, right? That technically these deposits might be uninsured, that anything over 250,000. But are they really uninsured if the government's going to step in and make everyone whole? Isn't that insurance in itself?
When Janet Yellen said this morning they'd even take care of the smaller banks. But here's the thing. There have always been uninsured deposits. Always. Are bankers playing fast and loose with your uninsured deposits? No, they're not. Jamie Morgan and his team, Jamie Dimon and his team at JP Morgan, they have great jobs. So do the guys at, Regions and Financials or Truist. They have these fantastic jobs, right? You know what happens to their jobs if they lose those uninsured deposits? They lose them.
Gone. Yeah.
So, did Silicon Valley Bank shares make a stupid bet? They did. That's a board that got too cocky. They really did not think that their venture capital depositors would leave because they'd been doing business with them for so long. However, set up by the fact that they were doing business with a lot of early stage venture capital companies. Okay. And they can't raise money anymore. Their ability to do a third or fourth round is gone because I'm going to use easy numbers. Let's say I did financing rounds in 2019, 2020, early stage, round one, round two. Then interest rates spike. So I did a round one at $1, round two at $1.50. When rates go up, everybody changes the valuation model, right? So now when I want to go back and raise money, it's 75 cents. It's called a down round. You know what's death to a startup? A down round.
Yeah.
So there was a very big handicap to fundraising ability. So preserving that cash became critical. And on that Thursday night before Silicon Valley Bank shares failed, remember, they made a bad bet on interest rates. They have massive losses. And the venture capital funds are actually calling their company saying, get your money out. We might have a crisis. As that money came in, they got hit with over 40 billion of withdrawal requests.
Yeah, and I mean, we talked about this on that Friday, but I mean, the problems at Silicon Valley Bank are very specific to that area of the. Yeah, and I mean, they're kind of a perfect storm for that collapse to happen, where the interest rates rose, not only kind of creating that hole in the bank's balance sheet because they bought all these bonds and now those bonds were depreciated in value, and also the companies they were working with then needed capital because they weren't able to raise any more money. Like, all these things happened in confluence and led to that collapse, but it doesn't mean, you know, all these other regional banks that might be working with. I mean, you pick a regional bank, right? We talked about, you know, a bunch of different ones that Friday, but that ones that aren't working with high tech startups aren't seeing those same withdrawal pressures. I've got a few names, Tim, because I actually was writing an article this morning about some of these names that have a lot of they had a lot of insider buying, like executives and CEOs were taking this opportunity to snap up shares. And that was what the funniest thing was to me. You go on Twitter, right, and everyone is all of a sudden a banking expert saying the whole system's going to collapse. And at the same time that people on Twitter are saying that, the executives at these companies are buying up millions of dollars of shares. And I'm like, which one am I gonna, you know, kind of look at and listen to here? The guys that are running the companies buying millions of dollars of shares with their own money, or people on Twitter who are now all of a sudden banking experts? And of course they were, infectious disease experts right when COVID hit, and then they were experts about something else 6 months ago, and
3 weeks ago they were artificial intelligence experts.
Exactly.
So yeah, you've got all these people giving advice who just not that long ago did not understand that banks own securities, or that the accounting for available for sale and held to maturity were different. They had no idea there was such a thing as uninsured deposits, or that, you know, it sounds horrible. In truth, it's benign. It's not an event. So yeah, when the insiders started throwing the 7-figure checks out there, you knew it was kind of time to get involved.
Yeah, so some of these names that I was looking at with insider buys, I don't know, of course, if you cover all of them because there are so many banks out there. Stifel was one of them. The CEO, Ronald Kruzewski, added more than $1 million worth of shares in the last 2 weeks. Stifel went from about a $70 stock down to a $60. So it didn't get as hammered, or $55. It didn't get as hammered as, a First Republic or a Western Alliance. But if you look at it, it was still trading down about 15%.
What's the symbol on that one, Aaron?
SF.
Oh, now see, that's an interesting one, because Stifel is not actually a bank. It's an investment bank that does a ton of business with banks.
True. Yes, exactly.
Never should have, worst case, Stifel would have been getting paid to clean up the mess. So it never really should have sold off.
And I know, so Stifel is headquartered in St. Louis. That's where I'm from originally, St. Louis, Missouri. And I know people that work there that, essentially were like, yeah, look, like, our CEO, not the most popular guy, but he looks out for himself, and he's not going to be investing his own money if he, doesn't think he's going to make a few bucks off of it. Other ones I was looking at that had insider buys, Pac West, from a bunch of different executives, from the director to the chairman and CEO. And Pac West, of course, has gotten hammered down from about $30, got all the way down to $6. And maybe Pac West, correct me if I'm wrong, is a little bit more exposed to like the tech sector and industry as some of the other banks.
Right, but the big difference here is that they're exposed to late stage venture capital companies that really did not have the same problem that Silicon Valley Bank shared. And they also had a much lower percentage of their cash in securities. I'm pulling up the securities holdings right now. So they had some problems, but they were never a threat to close the doors. They didn't have the same deposit base. They could have paid off all of their. All right, let me just see what mistake I'm making here to get into my database. Hang on. They could have paid off all of their tech-related depositors and still had cash, not been insolvent.
Yeah.
So, they sold off because really the name of the bank played a big role. PacWest and their relationship, but they didn't have the securities. They had not made the same massive interest rate bet. So it sold off. It's still, very cheap. But again, they could have paid off all of their tech depositors and still paid the dividend. So,
yep. And then another one that I was looking at that had insider buys. I don't know if you're going to be familiar with this one. Cullen/Frost, ticker CRF, located down in, I believe, San Antonio, Texas. I think works with a lot of energy companies down in Texas. And I mean, again, just a completely different
it's actually CFR. CRF is a closed-end fund.
Oh, sorry. I don't know what's going on. I took some cold medicine today because I've been dealing with stuff. So I'm just CFR, Cullen/Frost Bankers. That stock, again, maybe not as hammered as a First Republic or Western Alliance, but still went from 135 down to 100. So drawn down, about 25-30%. And, that.
They have a large securities account. Okay, 39% of assets are in securities. So that makes you think, oh my God, I got to get out. Except, it's when you buy is important. All right. They bought their securities coming into the end of 2020. They had about $12.3 billion in securities. End of 2021, $15.6 billion. Now rates start going up. Okay. And they're going up and they're going up. And in the second, third, and fourth quarter, as rates climbed and peaked, they bought a lot of securities. They didn't lose any money on them. Okay.
Because they're buying when the interest rates are going up, whereas the Silicon Valley Bank bought when they were lower, and then they weren't getting any more money while interest rates were going up, so they weren't able to keep buying securities as interest rates rose.
That's correct. And you look, they've got 87% at Cullen/Frost is in the available for sale, so held to maturity. No issues with that. But they added between the third quarter of 2021 and end of 2022, about $7 billion, or a 50% increase in securities buying as rates went up. So if we come over here.
So basically you're saying any losses accrued from buying those securities when interest rates were low can be essentially made up for with money made on securities bought when interest rates started to rise.
Right. Well, and the big thing is you're buying higher yielding securities, so you don't take as big a hit on the value of your bonds when other securities go higher. If you buy a bond at 1% and rates go to 4%, you take a huge loss. If you buy a bond at 3% and they go to 4%, you take a much more moderate loss.
Got it. Well, yeah, these were the three that I was looking at that had those significant insider buys, each more than $1 million worth throughout the past couple weeks. Cullen/Frost, ticker CFR, Stiefel, ticker SF, and then PacWest, ticker PACW. Tim, I asked you when we had you on a couple Fridays ago what your kind of top picks are. Now some of these stocks are trading a little bit lower, maybe more of a buying opportunity. So I'm going to ask you again. Maybe instead of 5, I'll just have you give your top 3 right now, as, again, some of these share prices are a little bit lower. So what are your top 3 regional bank stocks right now that you would be scooping up amid all this turmoil?
Okay, Helm Street out in Seattle. Love this bank.
That's HMST, correct?
HMST, absolutely. Really been getting hammered on. It's seen some option exercise back in January. Insiders own a lot of stock. They've not been, making any additional purchases. Primarily a multifamily lender on the West Coast. Their major markets are the Washington State and California. They also do some business in Portland, Oregon. Grown by smart acquisition. Committed to shareholder rewards, 7.7% dividend that was just recently raised. Book value is over $28. So you got an $18 stock price. Probably going to be a markdown in that book coming next quarter. Not a terrible securities position, really clean loan book. You buy it here, lock up that dividend, and just, ride it all the way out. First Financial Northwest, FFNW. Bank is located in Renton, Washington, up in that very wealthy Seattle area. These are both Seattle.
I'm sensing a theme here. You're liking the Pacific Northwest stocks right now.
Yeah, I don't like it that much as the numbers like it.
Okay.
The numbers are saying, hey, we like these. I'm like, all right, I'll go along with you guys. So small bank in one of the wealthiest areas of the country. Let's just come down here and get the percentages. Securities are 14% of holdings. So, not a whole hell of a lot there. Really clean loan book, diversified loan book. 0.01% of assets are non-performing assets. 0.02% of loans are actually late. Looking, 38% single family, 30% commercial real estate, 10% multifamily. So most of what they're doing is backed by real estate in a really wealthy area. Let's check deposits here. I'm sure we have gajillions of uninsured deposits. Almost 70% of deposits are insured. So, not a problem there. Deposit base has been extremely sticky. It's slightly higher than it was in 2020, actually increased in the fourth quarter. Plenty of equity on hand. Equity increased in the fourth quarter, not taking a lot of markdowns on securities. So just a good, solid bank trading at a very low multiple of earnings and book value. Would have to consider that. If I want to be in the Seattle area and I'm an outside area bank, I'm going to look to buy this one. So you
got it. And then, so we've got Home Street, ticker HMST, and then this one, First Financial Northwest, FFNW. You've got a third one for us, Tim?
Got a third one. Third Coast Bank Shares out of Texas, TCBX, business-oriented bank, one of the fastest growing by deposits banks in the United States. They're in Humble, Texas, a suburb of Houston. They've been smart. They've gone to the major markets, Houston, Dallas, San Antonio, currently moving in to the Austin area of Texas, which is a fast-growing area because of all the tech companies leaving California and coming to Austin. This thing's now trading at 60% of book. They don't have a securities problem. They don't really have a deposit problem. Let's just put TCBX in here. We've always done real well with the Texas banks. It's a market that is always consolidating. Banks that get cheap tend to get bought. This has gotten very cheap. Looking here for just total asset makeup. You got a whopping 4% of assets are in securities. Again, 66% of deposits are insured. They are a business bank, so there's going to be some larger business transactional accounts in there. So just nothing that you see here that's any problem. Great asset quality, primarily business and commercial real estate loans. You're not going to fall out if you see somebody come in and make an offer for this bank.
All these names, Tim, I'm noticing on the charts have been in a downtrend before this, banking crisis, whatever you want to call it. I know it's not really a banking crisis, but whatever you want to call it, really started. What do you think that's just because they're more growthy banks and because of interest rates, or why is that?
Well, interest rates had a part to do with it. Fears of a recession had a lot to do with it. Um, deposit pressure had an enormous amount to do with it. Because remember, before this happened, and we talked about this quite a bit, for the first time in, well over a decade, banks had competition for deposits. Interest rates weren't zero. You could get a 5% 1-year treasury. So people were looking at that. And so the banks started losing deposits late last year. So that did start pressuring a lot of bank stocks. And I mean, you can ask Jason, who's known me forever, if I buy a stock that's moving higher, call my doctor, something's wrong. I mean, almost everything I buy is moving lower. It's, the smartest thing I ever learned was to learn to love the down when it comes to stocks.
So right now, on that note, because banks had competition and stuff, especially where now that companies have seen the fallout of SVB and whatnot, I mean, what's the benefits and drawbacks from if you're a company right now putting money into just a T-bill, a treasury, whatever, at 5% versus investing it in a bank? Is it less liquid? I mean,
it's less liquid by a little bit, but yeah, you need your transactional account for payroll and for just regular expenses. Money's moving in and out of those accounts all the time. So to put it in treasuries is not effective. A lot of businesses having their charter, it's got to be in a bank.
Yeah, so you have some companies, I mean, like Apple's big enough to where they have a lot of money.
Apple's got a shitload of treasuries and bonds and equities and other stuff.
But they're big enough to where they can do that and then still have the money to make payroll and all this. A lot of other companies aren't in that boat, right?
No, that's right. I mean, remember, small business still drives the bus in this country, and that's smaller public companies. And, so there's still a lot of transactional. Mortgages got to be paid, rent's got to be paid, payroll's got to be made. That money's not going to leave the banking system. And, a certain amount is going to be held in reserve. And if it's less than 250, putting it in a treasury and then having to either margin or sell the treasury to get it back out is a pain in the ass. And, even in a 1 year, you can take a loss, not a big loss, but a loss. And so why risk that? Particularly, if you go back and you look at Home Street and Third Coast, they're really competitive on their deposit rates. They're keeping up. They're very close to what you could get on treasury rates. So why change?
Got it. Well, Tim, this has been a great follow-up discussion, good update on everything that's been going on the past couple of weeks. Anything that we haven't gotten to today that you think is pertinent that we do touch on?
Yeah, when we see these, because this isn't the last time we're going to see this kind of crisis, and we've seen it in energy before. Twitter is good for the first 5 minutes. It really, Twitter is a news source, and the first 5 minutes of any crisis or major news event is awesome. After that, it's all wild speculation. Okay. Like in this instance, you should have gone looking for the people who are the guys that have been talking about bank stocks for decades. And it's not just
you.
Me, guys like Phil Timian, an ex-private equity guy, is on Twitter talking about banks all the time. There's a, handful of people. There's not a lot of us. We're kind of a dying breed, but you want to look for the guys with the gray in their hair that have been around a while and listen to what they're saying about what's going on in the industry. Look at the numbers. If you just waited for the Fed numbers to come out on Friday and saw, hey, all of that money's out of New York and San Francisco. There's no money coming out of the Philly Fed, the Richmond Fed, the Atlanta Fed, the Dallas Fed, Chicago, St. Louis. There's nothing coming out of there. There's no big emergency withdrawals. Those banks must be okay. Then you start to get a little calmer about this and realize that we manufactured ourselves a lovely Wall Street crisis again.
Yeah, and I think to your point, I mean, about Twitter, social media in general, look for you can kind of test right now. Look back at what people were saying. The people that wanted to act like it was Chicken Little, the sky is falling, or, this is '08 again all over. I don't know if it's because they are short or because they just, like to be sensationalist. I have no clue. But there were people on Twitter that were like, okay, maybe this isn't as big of a deal as some people are making it out to be. And finding those types of accounts, finding those people that know what they're talking about, that you can really trust. And again, usually they're also interacting with other people that are experts in knowing it. I mean, You know, Joe Wiesenthal from Bloomberg comes to mind. He had he has a podcast on Bloomberg and brings on experts all the time, and he usually has a pretty good view of things that's not just what everyone else is saying, you know. So when, you know, all this was going down, he was one that I was, you know, following, interacting with. So just finding people like that you can, you know, think that, okay, they're actually gonna, you know, if they don't know what they're talking about themselves, they're gonna go to people who really do, the experts, instead of just saying what everyone else is saying.
Yeah, and that's, you know, look, we came into this banking crisis with plenty of capital. Even now, sitting here, there's no loan problems anywhere in the industry. None. Everybody's got a clean loan book. And it's going to stay that way because of the quality of the bank buyer has changed so dramatically in the last 2 years that your average bank borrower has really high credit scores and a great job. What lending problems there will be outside the banking system. You had plenty of capital. You had plenty of cash flow. So there's none of the things that usually make up a banking crisis. You know, 2008, that was a crisis. Collateral, you know, loans were going bad. That's a real crisis. Here, you just had panic. You had a one-off situation involving crypto, venture capital, and bad bets on interest rates that didn't spread. And once you saw the seven-figure checks coming out by insiders, that was it.
Yeah, I doubt you had a lot of those happening in 08, huh?
No, it didn't happen until 09. When you in mid to late 09, you started to understand that the dead were dead. You knew who the dying were. Everybody else was going to be okay. And that's when you saw the checkbooks come out in a very big way by insiders across a wide scope of industries, but also the banking industry.
Yeah, and I still think right now, I could be wrong, but I know, like, as when I last looked at it a few months ago, there still is a lot of, you know, cash on the sidelines, as people say, from institutional investors. I don't know if people are still worried about some sort of downturn or recession, or people are just waiting for rates to be cut. But I wouldn't be surprised to see when some of that cash starts coming off that sideline, the financial and banking sector is a big beneficiary of that, because again, you're still going to have some of these names that are depressed in terms of share price. And people also just like the fact that, like, hey, if the stock's going to go up and they pay a good dividend, that's pretty damn good, right?
Yeah, I mean, it's funny. You were talking leading in, it was banking and energy. And those are, you know, if you said, what are your two favorite sectors? It's banking and energy. They're cheap. The insiders are buying. You're collecting great dividends, and time is on your side. And if you're looking at it, you're saying there's going to be a recession, so I'm not going to invest, or, you know, there's not going to be a recession, so I'm not going to invest, you're probably making a mistake.
Yeah.
You know, there's two eternal truths. Value works and momentum works. Pick your camp or pick both camps and invest accordingly, and try to stay invested as much as possible. Trying to time or make guesses at this thing is usually a loser's game.
Yeah, and I know, again, like, one day's price action isn't indicative of a trend or anything like that, but on days like this where energy and financials are trading significantly higher, that's showing me that, okay, people aren't that worried about a recession right now. And the opposite's true too, that if I see over like a week or 2 week period, financials and energy just getting crushed, it's like, okay, people are maybe worried about a big downturn in the economy, because you don't typically see that unless there is some recession fears, or people just worried about, you know, the economy maybe not remaining as hot as it is right now, et cetera.
Yeah, and it's, you know, my final thoughts here before I've got to run off and get lunch and do some other things. But
yeah,
if you're hoping the Fed's going to reverse course and start lowering rates, because that playbook worked from 2010 all the way up through 2019 and 2020 even, you don't understand what's changed. Okay, once rates came up and the Fed didn't step on them this time like they've always done in the past, and they kept raising them, the game changed. We don't go back to that 2010 to 2020 playbook for a very long time. The market now has a voice in setting interest rates. If you're rooting for a Fed decreasing rates, you don't understand what you're rooting for, because the only way the Fed can afford to turn around and lower rates now with inflation at the levels that it's been printing is if something goes drastically wrong in the economy. You're literally voting against yourself because it takes something really bad at this point, like a recession or worse, for the Fed to reverse course. Reversing course is some ways out there unless something goes dramatically wrong. You need to go back and look at the playbook before 2010 to understand this has all changed and the rules are back to the old rules.
Yep, 100% agree. I mean, I think the Fed will at least keep rates where they're at until you see either inflation get below the 2% target or around the 2% target, or unemployment starts coming up and you start seeing some signs of recession. So I think they're just going to all of a sudden cut tomorrow or whatever. I don't know. I think people are...
It's not going to happen.
Not going to happen. All right, well, Tim, Melvin, thanks again for hopping on. I'm going to go ahead and drop the link in the chat. Banking on Profit newsletter you guys should all subscribe to. Again, Tim, thanks for hopping on with us today. Always great to have you.
All right, thanks, guys. We'll talk again soon, I hope.
Yep. All right, guys, that was Tim Melvin, our regional banking expert that we go to here at Benzinga. Always great info coming for Tim. We're going to go ahead and wrap the show up a little early, as you guys can probably hear, dealing with a little, I don't even know what it is, I think sinus infection, cold maybe, I don't know. We'll see, cold season. But thanks again for everyone hanging out. Please smash the like, subscribe if you have not already. As always, stay green, stay happy. We'll be back on Thursday with more Benzinga Live coming ready with some stocks, some trades to look at. Till then, peace.
This is Benzinga.